Assalamualaikum warahmatullahi wabarakatuh. Hello, my name is Mico Prayoga from Manajemen Class 22A with NPM 224111026. I will explain a little about the capital budgeting. Capital budgeting is a process for estimating income and capital expenditure. It is usually associated with assessing how profitable or feasible a company, capital investment, or major project are. Such investment capital may involve purchasing new machinery and equipment, replacing current machinery and equipment, or spending to build a new factory. Such investment require large funds, so success and failure can have a significant impact on the company. A company may have plans to develop several long-term projects. The company needs analysis to assess this project. Through company budgeting, management can determine and cost-wise of this project offers the highest return to maximize company value, so the company money is not wasted. Why is capital budgeting important? Several reasons explain why capital budgeting is important. 1. Help management to determine investment decision. Such decision may involve management selecting new facility or expanding existing facilities. In other cases, management might need to decide whether to replace existing facilities with new facilities. 2. Capital budgeting provides a method for assessing projects in an accountable and measurable manner. It is a measurable way for business to assess long-term economic and financial profitability when looking to introduce new projects. They can create a quantitative view for each proposed investment capital, thereby providing a rational basis for making judgment and decision. 3. Investment capital costs a lot of money, so its failure could have a significant impact on the company finance. 4. Strategic long-term project to support the company long-term competitive advantage. Its success will bring more growth in the future, maximizing shareholder wealth. On the other hand, failure can cause the company to lose out to competitors. What are 3 methods in capital budgeting to measure the feasibility of an investment? Capital budgeting decisions are a key factor in driving a company long-term growth and profitability. Therefore, management needs tools or methods to make wise investment decisions. These tools guide them in comparing the benefit and cost among investment alternatives, so they can choose the most feasible project among these alternatives. Several methods are available for capital budgeting, such as net present value, internal rate of return, payback period, accounting rate of return, profitability index. 1. Net present value. Net present value is considered the most important and therefore the most widely applied method. It covers how much money is spent and generated from a project after adjusting for time value. In other words, we calculate in by comparing the outflow for the initial investment with future after-tax cash inflow after discounting to get the present value. The mathematical formula for net present value is as follows. CF represents the cash inflow generated by the project for each period, that is, the cash inflow after adjusting for taxes. Then we must discount it to determine its present value at the assumed discount rate. The discount is to get an equivalent value when we compare it with the initial investment. Similar to the concept of the time value of money, a cash inflow now is more valuable than the same amount in the future. Therefore, we must first discount future cash inflow to obtain the equivalent present value. How to make decision from NPV? Investment capital is feasible if the NPV is positive. The greater the NPV value, the more profitable the investment. A positive NPV indicates the investment generates greater cash flow than the initial investment. Conversely, a project with a negative NPV is not feasible. Future cash inflow cannot cover the initial investment and therefore the project incurs losses. And an NPV might also be equal to 0. So it is not detrimental or detrimental. Management may consider intangible benefit to make decision. 2. Internal rate of return. Internal rate of return represents the discount rate at which NPV equals 0. In other words, it equates the initial investment with the total present value of the cash inflow. The following is the internal rate of return formula. If we look the internal return of return in the calculation above is similar to R in the NPV calculation. R we say is the minimum required rate of return. So when the NPV is 0, the discount rate we get will be the same as the internal rate of return. So how do you make decision using internal rate of return? An investment is feasible if the internal rate of return is higher than the required rate of return. Conversely, if it is lower, the investment is not worth it. So, how does this relate to decision making using NPV and investment a positive NPV when the internal rate of return is higher than the required rate of return. Therefore, we say the investment is viable. Conversely, when the internal rate of return is lower than the required rate of return, the NPV is negative, and therefore the investment is not feasible. 3. Repayment period. The payback period shows us how long the project investment will take to recover the initial investment. Of course, Management 1 when the project to quickly recover its initial investment and generate positive cash flow. For this reason, a shorter payback period is preferable because the project can recoup the initial investment more quickly. Maybe that's all I can explain regarding the capital budgeting. Thank you.